Let's get started with question number 8. A very important question. Let us first read this question. It's Entertainment Limited, an Indian amusement company, is happy with the success of its water park in India. The company wants to repeat its success in Nepal also, where it is planning to establish a grand water park with world-class amenities. The company is also encouraged by a marketing research report on which it has just spent rupees 20 lakhs. The estimated cost of construction would be Nepali rupee 450 crores, that is NPR 450 crores, and it would be completed in 1 year's time. Half of the construction cost will be paid in the beginning and rest at the end of the year. In addition, working capital requirement would be NPR 65 crores from the year end 1. After tax realizable value of fixed assets after 4 years of operation is expected to be NPR 250 crores. Further it says, under the foreign capital encouragement policy of Nepal, company is allowed to claim 20% depreciation allowance per year on reducing balance basis, subject to maximum capital limit of NPR 200 crores. The company can raise a loan for theme park in Nepal at 9%. The water park will have maximum capacity of 20,000 visitors per day. On an average, it is expected to achieve 70% capacity for first operational 4 years. The entry ticket is expected to be NPR 220 per person. In addition to entry tickets revenue, the company could earn revenue from sale of food and beverages and fancy gift items. The average sales expected to be NPR 150 per visitor for food and beverages and NPR 50 per visitor for fancy gift items. The sales margin on food and beverages and fancy gift items is 20% and 50% respectively. The park would open for 360 days a year. The annual staffing cost would be NPR 65 crores per annum. The annual insurance cost would be NPR 5 crores. The other running and maintenance costs are expected to be NPR 25 crores in the first year of operation, which is expected to increase NPR 4 crores every year. The company would apportion existing overheads to the tune of NPR 5 crores to the park. All costs and receipts, excluding construction costs, assets realizable value and other running and maintenance costs mentioned above, are at current prices, that is 0 point of time, which are expected to increase by 5% per year. So the question is very clear over here that all the cost and revenue other than those mentioned within brackets, they are subject to inflation of 5%. As a result, what you would do, these are at 0 point of time, that means these will be considered as real cash flows and these are expected to increase by 5% per year. But the question doesn't complete over here. Let us read the question further. The current spot rate is NPR 1.6 per Indian rupee. The tax rate in India is 30% and in Nepal it is 20%. The current weighted average cost of capital of the company is 12%. The average market return is 11% and interest rate on treasury bond is 8%. The company's current equity beta is 0.45. The company's funding ratio for the water park would be 55% equity and 45% debt. Being a tourist place, the amusement industry in Nepal is competitive and very different from its Indian counterpart. The company has gathered the relevant information about its nearest competitor in Nepal. The competitor's market value of the equity is NPR 1,850 crores and debt is NPR 510 crores and the equity beta is 1.35. State whether its Entertainment Limited should undertake water park project in Nepal or not? So friends, I would say one thing, the most critical thing in the question is this part. Look into, they have given the debt equity mix information, they have given beta of equity, they have given you the rate of returns which are for treasury bond, which can be considered as risk-free rate, and whatever is the rate of return prevailing in the market, and then the company's current weighted average cost of capital. Most importantly, they have given competitors' capital, which is further split into debt and equity beta of the competitor. So what we are going to do with all these information, we are going to first determine the weighted average cost of capital for this company, and for that the cost of debt and cost of equity both have to be determined. So cost of debt can be easily determined, because what rate of interest you are paying on your debt and what is the tax rate is enough information to arrive at cost of debt. However, to compute cost of equity, you have to look into the competitors' capital structure, because competitors' values have been given and the beta of the project will be identified only through the competitors' values given in the question. Through that, once you get the project beta, you apply the equation of beta on leveraged basis, and then you work out the equity beta. Through equity beta, you will apply CAPM and arrive at expected rate of return, which will be KE, or cost of equity for the company. Then taking weighted average of KD and KE, that is weighted average of cost of debt and cost of equity, which will eventually give you your weighted average cost of capital, or I would rather say adjusted weighted average cost of capital for the company. And now once you get that, that will become your discounting rate. So discounting rate in this question was missing, and a lot was needed mainly to arrive at that rate. Believe me friends, once we are done with that calculation, the ahead, that means the solution ahead, is not going to trouble you at all. So my request to all of you, please pay complete attention when we are dealing with this first part. So let us begin with that. Your attention on the screen. So in the solution, we are first going to definitely compute the cost of funds or the discounting rate for the company. And let us first do one thing. Let us first note down the competing company's information. Its equity market value is NPR 1850 crores. Its debt market value is NPR 510 crores. And its equity beta is 1.35. Now friends, if you recollect, we have learnt in portfolio chapter this type of equation. Beta of asset is weighted average of beta of equity and beta of debt, correct? So look into this equation. Let us understand this equation. This is the beta of any project or beta of assets, which is weighted average of beta of equity and beta of debt. To apply the weighted average, what we have seen, the weight of equity is equity upon debt plus equity, and for weight of debt, it is debt upon debt plus equity. So debt plus equity is your total capital. So equity upon total capital will become weight of equity, debt upon total capital will become weight of debt. So it is this way, beta of equity into weight of equity plus beta of debt into weight of debt. Second thing what we have learnt, that beta of debt, unless there is any specific information, we always consider beta of debt as 0, correct? That means if I substitute this as 0, this whole thing would become 0. But we will definitely have something from this part. And one more thing at the end, debt, we have to always take the post-tax debt value whenever the rate of tax is informed. So for determining the beta of the asset, that is beta of the project, we would take beta of equity of the competitor, that is 1.35, and we will take the value of debt and equity also of the competitor. But obviously, while taking the debt value, you should not take 510 as it is. We will make the adjustment for tax, and this part will become 0. Alright friends, you may pause the video if you haven't finished writing it yet. if you are done with copying this stuff, let us move ahead. And what we do now is, assuming debt to be risk free, that is beta is 0, the beta of competitor is ungeared as follows. So I have just eliminated the later part of the equation, because if the beta of debt is going to be 0, the later part will fully become 0. And you may see one thing, that debt has been subject to 1 minus tax rate. So we are taking the post-tax value of debt. So let us substitute all these values. So we have to find the asset beta or the project beta. So equity beta is 1.35. Mind it, these are all figures we have extracted from the competitors' data. So equity market value and debt market value subject to 1 minus tax rate. Finally, we get 1.106 as the asset beta. Now, we have to then find the equity beta for our company, right? So equity beta for its entertainment limited in Nepal. So how you are going to fund everything? Your asset beta in Nepal will be 1.106 as we have determined over here. Ratio of funding in Nepal, equity will be 55% and debt will be 45%. So we are going to use this ratio for finally determining equity beta for our company, and through that, when we find the cost of equity for our company or expected rate of return, and finally we can use that information for determining the weighted average cost of capital. Alright friends, you may pause the video if you have yet to write it, and if you are done writing it, let us move ahead. So what we now do is, we write up the equation again. So let me explain this equation again. This is the asset beta what we have just derived from the earlier equation. Equity beta for our company for this project is unknown. Now we take the equity and debt value. The equity value we don't know, but we know the proportion. So we have taken 55 and 45 as the proportion of equity and debt. But you see one thing, the equity is 55 as it is, and debt over here is considered after taking the tax effect. So 1 minus tax rate. Mind it, because this is an Indian company, for making this calculation, the tax rate that you consider should be the tax rate applicable in India. And now when you solve this equation, you finally get equity beta as 1.74. Once you get equity beta as 1.74, do one thing, don't directly copy this information. Make this equation calculation and make sure that you get equity beta as 1.74, then proceed ahead. Okay. So cost of equity as per CAPM, that is expected rate of return on your equity as per CAPM. You know the CAPM equation very well, RF plus RM minus RF into beta. So risk-free rate which was given on government bonds as 8%, average return on market was given as 11%. So we have RF and RM information. Beta of equity we have just calculated as 1.74, and finally we substitute these values in this equation to calculate the cost of equity or expected rate of return for the equity, which we obtain as 13.22%. Now we will apply weighted average cost of capital. So that is cost of equity into weight of equity plus cost of debt into weight of debt. So what we get is 13.22 as cost of equity from CAPM, weight of equity is 0.55 plus cost of debt will be the post-tax cost of debt, right? And rate of debt is 9%. Because you are raising funds in Nepal, the post-tax cost of debt will be 9 into 1 minus tax rate of Nepal, that is 1 minus 20%, and multiplied by weight of debt, which is 45%. Finally, what you get is weighted average cost of capital as 10.51%. Now, once you calculate 10.51%, this is going to be your discounting rate. Alright friends, so you may pause the video if you have yet to write, and if you are done with it, let us move ahead. And what we do first now is, we make calculation of capital allowances or depreciation which is permissible in Nepal. So understand one thing, we will be taking year 2, 3, 4 and 5 because these are the only 4 operational years. You know one thing, from 0 year till end of year 1, your construction activity goes on and on. So the park will remain open for operation from year 2 onwards. Now your total capital expenditure is a huge amount, right? But as per the policy of Nepal government, maximum allowance that can be given will be 200 crores in terms of Nepali rupee, that is NPR 200 crore. So your capital expenditure is actually more than this amount, but you will not be getting benefit of depreciation beyond this. So what we do is we take depreciation in terms of 20% of this opening balance, and what we get as closing balance is 160, which gets carried forward to the third year, and again you take 20% of 160, that is 32, and you go on doing that. Finally what you get is depreciation allowance, or you may say capital allowance, for the 4 years of operations. Alright friends, time for you to pause the video if you have yet to finish writing this. If you are done with it, let us move ahead. What we do next is we make calculation of the free cash flows at present. So don't forget, your operational years are only years 2, 3, 4, 5, and now these calculations are going to be very simple. Expected annual visitors. I am sure I don't have to explain you how we get 50,40,000 visitors every year, but still if you are not clear with how we got this, you look into one thing. The capacity of the park is 20,000 visitors per day, which is going to be used only to the tune of 70%. So 70% of 20,000 makes it 14,000 visitors per day, multiplied by 360 days will give you 50,40,000 visitors every year, and that remains constant for all these years. Now entry ticket price per visitor, how would you determine this? Please understand this thing carefully. The prices they have given in real terms, that is the prices prevailing at 0 year. The price was given to you as 220, correct? And the inflation rate is 5% per year. So what you are going to do, 220 plus 5% for year 1. But mind it, our starting point is not year 1, it is year 2. So it will be 220 plus 5%, that gives you 231. Again plus 5%, that will give you 242.55. So I repeat, how to get this calculation? Don't forget that this is second year. 0 year price level is given as 220 and 5% is the rate of inflation. So your calculation will be 220 into 1.05 into 1.05. So basically it will be 220 into 1.05 raised to 2. So for third year it will be 220 into 1.05 raised to 3, or alternatively you may take 242.55 plus 5%. Either way what you get is 254.68. Friends, I repeat once again, it will be 220 into 1.05 raised to 3 or 242.55 plus 5%. Either way you get the same thing, 254.68. And similarly you will make calculations for year 4 and year 5. Now next thing what we have to do is profit from sale of food and beverages per visitor. Let us understand the calculation of this working. As per the question's information, each visitor is going to spend rupees 150, that is Nepali rupee 150 towards food and beverages. So 150 multiplied by its contribution ratio, which is given as 20%. So 150 into 20% would give you 30. Now 30 NPR, that is Nepali rupees 30, will be at the 0 year price level, and this is again second year, correct? So it will be 30 multiplied by 1.05, again multiplied by 1.05. That is 30 multiplied by 1.05 raised to 2. That gives you 33.08. So friends, let me explain this calculation once again. It was spending by visitor NPR 150 multiplied by the contribution ratio, that is 20%. 150 into 20% gives you 30. 30 plus 5% and again plus 5%, that is we have added 5% 2 times, or we would say we have multiplied 1.05 2 times to 30 NPR. to obtain NPR 33.08. Once you get this, the next year calculation will be 5% more than this, which is 34.73. Next year calculation will be further 5% more than this, that is 36.47, and finally 38.29. Exactly same way we would determine the profit from sale of fancy gift items per visitor. In this regard, the question informs you one thing very clearly: every visitor will spend rupees 50 towards fancy gift items, and the contribution ratio is 50%. So 50% of 50 would give you 25, but 25 will be at 0 year price. So what you do now is, for finding the value of second year, it will be rupees 25 into 1.05 raised to 2. So 25 into 1.05 again into 1.05 would give you 27.56. Once you get this, add 5% to this to arrive at third year value, add 5% to this value to arrive at fourth year value, and so on. Finally, these are all the net revenues, and we add up all these to get revenue per visitor. So inflation factors have been accommodated already. So we have number of visitors over here, and we have the revenue per visitor, and we multiply the number of visitors with revenue per visitor, we get total revenue in NPR crores, which already accommodates the inflation factor. 152.81 in second year, 160.45 in third year, 168.47 in fourth year, and 176.89 in the fifth year. Alright friends, you may pause the video if you have yet to finish writing this, or else if you are done with it, let us move ahead. And what we do next is very simple task. We just get started with that total revenue that we have worked out in the earlier working, and now we will subtract all the cost. So annual staffing cost. So what you find, the base figure given to you was NPR 65 crores, correct? So if it was NPR 65 crores at 0 year, what you would do for arriving at second year's value? So it will be simply 65 crores and added 5% inflation for year 1 and year 2. In other words, what we have been doing for revenues, exactly same thing we have to do for this annual staffing cost, that is 65 crores into 1.05 into 1.05, that is NPR 65 crores into 1.05 raised to 2. What you get is 71.66. The third year value will be 5% more than that, fourth year value will be further 5% more than that, and fifth year value will be further 5% more than what you obtained in fourth year. Now what about insurance cost? Exactly same way. So it was given for 0 year as 5 crores. So you will take 5 crores into 1.05 raised to 2 for second year. Then for third year, just add 5%, 5.79, again add 5%, you get 6.08, again add 5%, you get 6.38. Now with regards to other running and maintenance cost, this information is separately given to you, where the usual inflation rate of 5% will not apply. Here it is given to you separately that it will increase by 4 crores each year, correct? Now for the first year of operation it was 25 crores, and then 4 crores added each year. The cost increases in that tune, and as a result the 5% inflation is not applicable to this component of cost. And depreciation on the other side, being based on the historical cost of the asset, again this has nothing to do with inflation, and this working we have shown earlier. I don't have to explain you how we got this. So total expenses, the aggregate of all these expenses, and we have on top our revenue line. So we get the profit before tax in NPR crores. Alright friends, you may pause the video if you have yet to write, and if you are done with it, let us move ahead. Time for us to determine the annual cash flows for each of these 4 years of operation. So profit before tax, what we just got earlier, tax on profit in NPR crores. Remember, tax rate in Nepal is just 20%, okay? So net profit after tax in NPR crores, and finally what you do is add back the depreciation allowance to arrive at your annual cash flows. Now this is very simple, I don't have to offer any explanation. Alright friends, you may pause the video if you have yet to write, and if you are done writing this, let us move ahead. And finally what we have to do is plot all the years from 0 to 5 and just record the annual cash flows that you obtained in the earlier working. The park construction cost will be 450 crores, spent half in 0 year and half in year 1, and nothing else to be spent in terms of initial investment. Post tax asset realization, the net of tax amount is directly given to you as 250 crores in Nepali rupee, that is NPR 250 crores. And then working capital. Now look into one thing, your working capital is basically blocked into what type of asset? If you understand, it is blocked into those inventories of food and fancy gift items. Obviously with the inflation rate, your working capital requirement will also be increasing. As a result, at first year end you have to put 65 crores of working capital. By the time you arrive at second year end, because of the changes in the price level of your inventory by 5%, you will need some extra investment. So it will be 65 crores into 5%, extra working capital will be 3.25. So by end of second year, your overall working capital investment will be 65 plus 3.25, that is 68.25 crores. On that you add 5%, so your extra working capital, that is 5% of 68.25, will be 3.41 crores, and in the fourth year again this whole cumulative amount into 5%, 3.58 crores. By the time you arrive at fifth year, you are going to recover all these values. The realization of working capital will be 75.24 crores. Now assume that this amount was not held in any inventory and it was just held in the form of cash, then inflation may not affect all this, and as a result you would have taken 65 crores over here as initial investment and 65 crores over here at the end as the final realization. So that also could have been an alternative way of dealing with this situation. However, we have gone with what exactly ICAI has done in its module. So what we get is net cash flows. Once you get net cash flows, you know the discounting rate we have worked out earlier, that was 10.51%, and the PV factors at such discounting rates are given over here. Multiplying these PV factors to these net cash flows, what you get is the present values of the cash flows, and once you take aggregate of all this, all negative and positive cash flows at their present values, when aggregated, it is giving a huge negative NPV, that is NPR 165.8 crores negative NPV, and obviously your conclusion is going to be that you are not going to make this investment, you are not going to accept this project.